Welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the weeks ahead. Now, as ever, don't forget, if you find any of this useful, please hit that like button and subscribe to our YouTube channel. Now, this show is for everybody, even if you are a passive investor, because you're probably wondering what's been going on with your portfolio in the last couple of months and year to date. So we go through everything that's been going on in October and what to look out for in November. And it's been an eventful month in investment markets. If you recall, the weakest August performance for US stocks since 2015 was swiftly followed by the worst September since 2002. Now, as mentioned at the time, September is historically the weakest month of the year for most equity markets, and history certainly repeated itself, with the S&P 500 falling by an incredible 9% during September 2022. Now, seasonality has had a significant influence on investment markets recently, and much like a weather forecast, seasonality doesn't determine the actual weather, in this case investment performance you experience on a given day, but it does provide context for the likely range of outcomes that you might see. But just like the weather, investment market performance is unpredictable and you can be surprised. And you can overextend the metaphor if you want to and talk about droughts and hurricanes or periods of time when events are outside of expectations. But as we headed into October, investors hoped seasonality might once again play an important role on investment market performance. And that is because typically October is one of the strongest months for US equity returns, especially during a US midterm election year such as 2022. In fact, October started with the best two-day start to a month ever for the S&P 500 as investors panicked that they might miss out on the bottom of the market and all started to pile in. Now, the prevailing narrative at the time became that the Bank of England had potentially pivoted somewhat by restarting its QE program, and then hopefully the Federal Reserve and other central banks would perhaps follow suit. Now, the initial FOMO, so that's the fear of missing out, that was driving equity markets around the world actually started to fade, and many equity markets either revisited their 2022 lows or came close to doing so by mid-October. Now, if you look at the charts, if you get out your phone, for example, and look at your stock app, then ultimately you will see that there was a rebound in October. So seasonality did deliver, and that's especially true if you're in the US, where the Dow Jones had its best October ever and its best monthly performance of any month in over 26 years. Now, if you look at the Dow Jones, it rose almost 12% in October, while the S&P 500 rose 8%. If you head over to Europe, the German DAX, which is often closely correlated with the fortunes of the S&P 500, I've mentioned this in the past on this show, that rose 8% as well. But the euphoria wasn't seen across all equity markets, with Asian and emerging markets falling into negative territory during October. Now, that was largely because of a 16% slump following Premier Xi's renewed grip on power and the continued COVID lockdowns that were occurring in China. Now, in the UK, equity markets eventually managed to drag themselves into positive territory, despite the mayhem caused by the now former Prime Minister Liz Truss and the now infamous mini budget. Now, one of the potential headwinds for investment markets during October was the latest corporate earnings season, which is where companies reveal their Q3 earnings and provide updates about the outlook for their company and their earnings in the future. Now, while earnings season posed a potential banana skin, investors took the disappointments that occurred in their stride, especially from large US tech stocks. Now, if you look at Meta, which was formerly known as Facebook, that was rocked by a drop in advertiser spending in the face of a global economic slowdown. And the immediate aftermath of the announcement saw the company's share price tumble more than 20%, which is an incredible move. Now, Alphabet also saw its shares fall by 8%, so it's a much smaller fall, but it's still a significant one after it announced its own slump in advertising revenues. But not to be outdone, Amazon shares slumped 20% after reporting its revenue numbers and warned of far weaker sales figures in the upcoming festive period. Now, such wild swings in share prices are what you'd expect of penny stocks, not mega cap stocks, especially these huge tech companies. But should we be surprised by anything that we see in 2022, to be honest? Now, while individual tech stocks sank dragging the Nasdaq 100 down with them, it wasn't enough to derail the wider market. And it means that corporate earnings season has, on the whole, been well received, partly as a result of the low bar of expectation that was set, but also because of how oversold stock markets had become by mid-October. Buy the dip mentality eventually returned to equity markets in the second half of October, and we even saw sector rotations, which are usually what sustained market rallies are built upon. So we saw people moving from tech to things like energy. Now, moving into November, this buy the dip mentality remained in place. But as I suggested at the time to 80/20 investor members, the equity market euphoria and to a certain extent the relief rally in bond yields, which was partly because of an absence of central bank policy decisions in October, it did suggest that the stage was set for either a significant move higher as we moved into November or a big disappointment. And the catalyst was always likely to be the central bank policy decisions from the Fed and the Bank of England in the first week of November. But most of the attention was always going to be placed on what the Fed did because the market needed to work out whether it had actually jumped the gun on the dovish pivot narrative that had been driving a lot of the recent market moves. In the end, there were rate rises by both central banks in line with expectations, but there was a more hawkish than expected press conference from the chair of the Federal Reserve, Jerome Powell, and that saw equity markets pull back, especially in the US, where on the day, equity markets fell between 2 to 3%. But in an interesting twist, market performance of various equities around the world has been almost the inverse of what we saw in October. And by that I mean US equities are actually struggling now and emerging markets are rallying. And in particular, Asian equities have been doing quite well at the beginning part of November. I mean, it's early days yet, but it reflects the 360-degree change in narrative surrounding both regions. Now, in October, COVID lockdowns contributed to the slump in Chinese equities, dragging down emerging markets more widely. But in November, we've got rumors circulating around that China might finally move to actually get rid of some of the restrictions that relate to its COVID lockdowns, which would be obviously a big boost for its economy. Meanwhile, in the US, the second half of October was characterized by that narrative that the Fed would pivot and become more dovish, when in reality, what we've seen in November is that the Fed is sticking to its hawkish course. So that is why we've seen that change in performance. Whether that will be the case throughout November, we'll have to wait to see. But both of these narratives are in a state of flux, and it just emphasizes the level of volatility we are seeing in investment markets. Other hurdles for November include the US midterm elections, and the actual outcome is often less important than there being an actual outcome. So that will make more sense to people who are 80/20 investor members, as I'll write a bit about it this week in the newsletter. But we are also going to find out the new inflation data for the US in particular this month, but of course we'll find it out for other countries too. But in the US, it's going to be particularly noteworthy because it could dictate the market narrative over whether the Fed will become more hawkish or more dovish. So expect volatility around that event. And also, you can expect if inflation comes in higher than expected, it could likely be bad news for bonds and equities, as it has been in recent months. But there are reasons to be cheerful. So let's finish this episode on a positive note, because we are entering the best 6 months of the year for stock markets based on seasonality. And November should normally be a positive month for US stock markets, especially in a midterm election year. So that usually translates to other equity markets around the world. But as October proved, that doesn't always happen anymore. Now, with so much uncertainty, I want to leave you with some technical analysis numbers to keep an eye on for the next sort of couple of weeks. And I've taken these from the latest research piece I've done for 80/20 investor members, where I look at the outlook for the S&P 500, the FTSE 100, the Japanese stock market, and even the pound dollar exchange rate, which is really important for UK investors. Now, just to give you a couple of sort of bits out of that, for the S&P 500, keep an eye on the 3,900 to the 3,925 level, because in the short term, this is a level that needs to be overcome if the rally that started in late October is to continue. On the downside, then 3,580 is going to be important because that is near the low of the 2022 bottom. So moving over to the FTSE 100 in the UK, we want to see that recapture 7,300, which is also where the 200-day moving average is. Remember, it's often deemed that if the market or index is above the 200-day moving average, that's positive, bullish. If it's below that, then it is bearish. At the moment, as I make this video, we're just about on that level. So on the downside, then there are plenty of support levels on the way down towards 7,000, but 7,000 is a psychologically significant number to keep an eye on. So that is it for this month's video. If you've enjoyed it, make sure you hit that like button and don't forget to subscribe to our channel.